Many Kenyans yesterday received with a sigh of relief the news that interest rates on bank loans could be capped at 4% above the central bank rate if President Kenyatta assents into law the Banking Amendment Bill 2015, passed by members of parliament. However, commercial banks have come out with guns blazing, warning that they will now be forced to restrict loan facilities to corporates and high net worth individuals, since the capped interest rate is too low to cover the high-risk worthiness associated with most Kenyans and SMEs.
Borrowers whose risk profile is on the higher side, higher than what's legislated within the law, will then have to get credit elsewhere. And that's why the reason you're saying that these borrowers will therefore now have to access the informal lending sector, the shylocks, and the other unregulated lenders.
They say capping interest rates might weaken the local currency if people resort to borrowing loans in foreign currencies whose rates are not capped, hence creating another microeconomic problem.
In a country like Kenya, if you cap the interest rates in the shilling, then those who could not access shilling borrowing because they are excluded because of that cap will then opt to borrow in foreign currency. And that weakens the local currency, that weakens the shilling.
They propose that a concessionary fund be set up by all banks to cover for persons at the low end of the economy, as opposed to capping interest rates for a free market economy like Kenya.
So what we are doing is we are taking a proportion of the total portfolio of the banking sector and specifically earmarking it for the benefit of these SMEs that will have been taken through some capacity building training program, and once they are able to access the funding, they are then facilitated and availed the funding at concessionary rates.
Separately, Kenya Women Holding Group CEO Dr. Jennifer has pleaded with the president not to assent to the bill, noting that it will erode against made in financial inclusion, where women are the majority of those to be excluded.
The control of financial sector does not depend on capping interest rates. It depends on streamlining the operations and the governance in the financial sector. It has nothing to do with interest rates. So people are beginning from the different side, from the flip side of saying interest rates are high, but they are not looking at the malpractices in the banking sector that are driving interest rates. So this is a misnomer.
The banks have received a backing from the Central Bank of Kenya, which says capping interest rates will have adverse consequences on the economy. In a statement, CBK says this would include inefficiencies in the credit market, credit rationing, promotion of informal lending channels, and undermining the effectiveness of monetary policy transmission. Whether the status quo will be maintained or interest rates would be capped would be known within 2 weeks, the period the president is required to either sign the bill or return it to parliament with the proposals. Nicholas Ndwati, Business Insight.